All right. I will get us started for today. A very warm welcome, everyone. I'm going to open us with karakia and then we will get into it. Tū taua mai e runga, tū taua mai e raro, tū taua mai e roto, tū taua mai e waho. Kia tau ai, te mauri tū, te mauri ora, ki te katoa, haumie, huie, tai kie. Welcome, very warm welcome, everyone. My name is Alicia Sudden. I'm the Kaiwhakahaere Matua of the New Zealand Council of Christian Social Services. We're a national umbrella organisation who advocates for social justice and equity, representing over 100 member organisations across Aotearoa. We're also very proud to be a member of the Better Taxes Coalition. A bit of background about me. I've spent a lot of my time helping to spend money in government, in particular on addressing income. So I'm excited to be here to talk about how we can earn a little bit more today with tax and revenue. So it's very special to be here. This is the final in Tax Justice Aotearoa's Tax on Tuesdays series on their tax policy statement. So it's a very special one today. Aotearoa New Zealand is often described as an outlier among developed economies when it comes to our tax settings, but how different are we really, and what can international comparisons tell us about the choices we have made? This session will explore how New Zealand's tax system compares with other economies and whether the policies proposed in Tax Justice Aotearoa's tax policy statement would bring our tax settings closer to other international norms. Today, I'm going to lead our panelists in a discussion about different aspects of tax. There'll then be an opportunity for questions later on at the end of the hui. Please, as we go, put your questions in the chat and we'll keep a record of them. The session today will wrap up at 1:30. Just before I kick off, I do want to remind everyone that Tax Justice Aotearoa is the lead organisation in the Better Taxes for a Better Future campaign. The campaign is supported by a coalition of around 25 organisations, and if you haven't already, it's a really wonderful thing to support. So I highly recommend you look up their campaign and learn a little bit more about how you can have positive and useful discussions around tax. They're campaigning for a tax system that will enable us to gather resources we need to fund the things that matter and to do it in a way that is fairer. For those who aren't already, we'd love you all to get involved and support this mahi, and Glenn is going to post some links in the chat, which it looks like he has already. So please, when you get a chance, have a look at those. There's some really wonderful in-person sessions as well, which are really valuable if you do want to learn more. Alrighty, so I'm now going to introduce our speakers. So I'm going to start off with Max Rashbrook, who's a writer and researcher with interests in economic inequality and democratic renewal. I was very fortunate to have Max as a speaker at a recent conference that we hosted, and he was a highlight for many attendees, so looking forward to today. His books include Too Much Money, How Wealth Disparities Are Unbalancing Aotearoa New Zealand and Government for the Public Good, The Surprising Science of Large-Scale Collective Action. An adjunct research associate in Victoria University's School of Government, he has also recently helped launch IDEA at the Institute for Democratic and Economic Analysis, a new public policy think tank. Max will talk about inequality in our tax system, particularly in relation to GST and personal income tax. So Max, before we start, the question that I want to hear from you today, what can you tell us about our levels of inequality here in Aotearoa, and how are our tax settings contributing to that?
Yeah, look, well, thanks for the question, Alicia, and thanks for everyone for being here. Um, yeah, look, we've got very significant disparities between rich and poor in New Zealand. As people may have heard me say before, they widened more between the mid 1980s and the mid 2000s than in any other developed country. We used to be a country where the richest tenth of people earned about 5 to 6 times more than the poorest tenth, and that ratio has widened out to 10 times. The Someone in the wealthiest 1% of New Zealand would have probably 70 times the wealth of the typical New Zealander. So there are huge disparities, and yeah, and our tax settings don't do a huge amount to reduce those disparities. I've got some slides on that I can talk to, but yeah, we're one of the worst performers in the developed world when it comes for reducing disparities using the tax system.
That's great. Would really welcome the slides at any point, so do feel free to put them up. How different do you think our levels of inequality are from some countries we compare ourselves to, and what contribution do tax specifically make to that?
Yeah, well, maybe I will share slides at this point, just because it might be easiest to do that through a few graphs. So, um, yes, this is a graph using the something called the Gini coefficient, which is a very technical term, and I won't sort of bore people with the finer points of it. But basically, it takes all the disparities between rich and poor, each gap, sort of income gap between each person, and sums them all up and turns them into a single number, where a higher number means more inequality and a lower number means smaller disparities between rich and poor. And this first graph basically is telling you what's the disparity between the cleaner and the CEO just on their basic salaries before taxes and welfare payments come into view. And, on that sort of that basic sort of the salaries that are handed out in the marketplace, we're about middle of the pack in terms of that disparity between cleaner and CEO. But then when you look at the same figure after the welfare system has done its thing, we've shifted to the right. So we perform relatively badly when you look at the disparities between people after everyone's paid tax on their income and some people have received welfare benefits. And so the fact that we fall down the rankings when you start to look at the effects of the tax and welfare system tells you that it's not doing a very good job. And that's the last slide. So this slide is how much does the tax and welfare system reduce the disparities between rich and poor? And you can see right out on the left that Finland's tax and welfare system does a huge amount to reduce the disparities that are there. We are the red bar, which is about three-quarters of the way along to the right. So our tax and welfare system does less than the American tax and welfare system to reduce the disparity between the cleaner and the CEO. So if one of the things that you want a tax system to do is reduce disparities between rich and poor, our one does a very poor job of it. And in fact, the few countries that are off to the right, which have even less effective systems than ours, includes a lot of countries like Costa Rica, Chile, and Mexico that we wouldn't normally compare ourselves to. So in terms of the countries we do normally compare ourselves to, Australia, maybe Iceland, Israel, Switzerland at a pinch, we have genuinely one of the least inequality reducing tax and welfare systems in the developed world.
Yeah, that's really useful, especially with those graphs. What do you think those other countries who are doing wealth transfers better have got right that we haven't got right yet?
Well, they do a whole lot of things. So just at a very basic level, they'd have a higher top income tax rate. Ours is 39%. Um, in some countries like Finland, it would be up around 50%. They also have capital gains taxes. We tax capital gains less than any of the countries on this slide. Virtually everyone else has got some functional form of capital gains tax. Some of them will have inheritance taxes as well. A small number of them will have wealth taxes. And so because they've got all those other taxes, they rely a lot less on GST, which is regressive because it's flat rate, so it takes a bigger chunk out of the incomes of the poorest New Zealanders. And yeah, and so they have a lot more taxes that fall on higher income earners, which also generates a whole lot more tax revenue, which they can then use to fund their welfare systems better. So those two things are obviously closely connected. But yeah, generally, it's a whole suite of policies, really, that we are not deploying here.
Speaking of GST, the Tax Justice Aotearoa's tax policy statement suggests that there could be ways of limiting the regressive nature of GST. They've suggested either through a system of rebates for those on low incomes or a card system at point of purchase. Do you know anything comparing to other countries, how successful or other mechanisms that they've used to try and address that regressive nature?
Yeah, look, my view would be that if you're going to try to do that, the first option of basically doing it through welfare payments is the most sensible. And I don't even really know if you need to tag that to GST, particularly in all honesty. Other countries' GST equivalent systems often have a lot of exclusion, so there's no GST or equivalent on fresh fruit and vegetables, as Labour proposed last time round, or not on certain kinds of food, but other kinds of food, or some other, supposed sort of necessities are exempted. In some countries, books are exempt from GST. Um, and I personally don't think that works particularly well. I think it makes the system more complex. You spend a lot of time arguing about whether things are exempt or not. Um, the reduction in GST isn't necessarily passed through to the consumer. So sometimes the people making those goods just profit the extra 15% or whatever, and there's no net improvement. So I think if you're going to try to offset the effects of GST, doing it through the welfare system makes sense, but I think we should be increasing benefits anyway. So I don't know that that needs to be done, particularly with regard to GST, in all honesty.
Yeah, great. Thank you. Wholeheartedly support that call for increases in the welfare system as well. Another thing that's in Tax Justice Aotearoa's tax policy statement is a tax-free band at the bottom of the income tax schedule. Is that something common across other countries? And what are your thoughts on how that might help address inequality in Aotearoa?
There's certainly a number of tax systems that do have a tax-free threshold at the bottom, so you don't pay tax on the first X thousand dollars of your income. Australia has quite a generous one. Happy to be corrected on this, but from memory, you don't pay tax on something like the first $18,000 of income there. Britain also has one. Can't remember the exact amount, but it might be in the range of about £10,000, something like that. Something relatively generous. And that does make sense up to a certain point, because if people are really struggling to afford the basics, then why are we even requiring them to pay income tax on that opening income? Is a reasonable point of view. There are a couple of counter arguments. One is if lower income people aren't paying tax, or aren't paying tax on very much of their income because you've got a large tax-free band, then it's even easier for the right to stigmatize them as grifters and people who are sort of sucking on the teats of the welfare state and not contributing their fair share. The other issue is that you would sort of, at first glance, provide that tax-free threshold that, no tax paid on the first however many $1,000s of income to everyone, including people who are earning hundreds of thousands of dollars, and that's probably not very efficient. You can claw that back off those higher earners in other ways, which I think Britain does, although that gets complicated. And the other trick would be, obviously it's expensive to take tax off the first even few $1,000s of income. And given that New Zealand's tax system generally suffers from not generating enough revenue to fund the public services that we want, it is always challenging to see how you could fund that tax-free threshold and increase spending to public services.
Yeah, great points. Thank you. You also mentioned earlier around some other countries and the differing top income tax rates that they have. Are there any examples that you think of other countries that are doing it well that we could learn from?
Um, well, look, that fairly simple. Just other countries often have higher top income tax rates than we do. In Australia, for instance, it's 45%. So just very simply, you could increase the 39% rate, or you could have another higher rate above it. I guess my only caution there is that that is just getting more money out of people who are already in the tax system, because that'll catch people who've got conventional salaries and who are paying PAYE. The big gap in the New Zealand tax system, as other people are going to talk about, is the fact that we don't tax other forms of income like capital gains and inheritances. And it's that absence that means that the wealthiest New Zealanders, according to the Inland Revenue, are paying a tax rate on their income of probably about 9%, which is less than someone who's stacking shelves in a supermarket. It's half the tax rate overall that you and I and ordinary people pay. We generally pay about 22% of our income as tax. Wealthiest New Zealanders are only paying 9% of their income in tax. That's not really going to be solved with a higher top tax rate. That is much more likely to be solved with a capital gains tax and or an inheritance tax or a wealth tax.
Wonderful. That seems like a very good time to head into our next speaker. But before we wrap up, Max, anything else that you wanted to share on this topic?
No, I think that's pretty much everything.
Wonderful. Well, let's start talking about some of those other taxes and capital then. I'm really excited to introduce our next speaker. So, Lisa Marriott is a professor of taxation at the Department of Accounting and Commercial Law at Victoria University. And she's an extraordinary professor at the University of Pretoria in South Africa. Lisa's research interests include social justice and inequality, which seems perfect for today. She has a particular interest in the behavioural impacts of taxation. She's going to talk about capital taxes such as capital gains, wealth, and wealth transfer taxes. So, to kick us off, Lisa, why is New Zealand apparently so resistant to introducing a capital gains tax when, as Max pointed out, most OECD countries have already managed to do this? What do you think we need to do to get over the line?
Yeah, and isn't this a question that I suspect at least a couple of our political parties would be quite keen to know the answer to? I think one of the issues in Aotearoa is, and I'm not speaking or referring to the audience we have here when I say this, but we don't have a very financially literate population in general. It's very well established that we just don't do a good job with teaching financial literacy. And knowing some sort of basics around tax is really important because people who understand taxes on capital or wealth actually really appreciate the fact that it's not something which is everybody's going to pay, that it is fair and that it achieves really good objectives like addressing inequality. So that's one thing I think is the low financial literacy. But then when you put alongside that some of the misinformation that you see around these types of taxes, the reality is, as Max said, they're targeted usually so that it's only the people who are making the largest gains who actually end up paying these taxes. And if people genuinely understood that and appreciated that this isn't the tax department coming after their family home, then there would probably be a lot more acceptance of it. And actually, I don't know that there's actually that much resistance anyway. A lot of the surveys that have come out in more recent times have said that actually people are willing to consider this. So, yeah, it is important. Everybody here knows that it's important, but I just think we need to do a better job with the messaging and the way it's sort of being sold. The Labour Party policy that is out, I'm probably not the hugest fan of, but the one good thing it does have is it's simple. People can appreciate that it's only on those who own other residential properties, so not your family home. So the simplicity is really nice. Other things about it I'm not quite so keen on, with it only being on residential housing or other than owner-occupied properties. But there's a certain, I think, cleverness about that and being able to sell it because people will readily understand that it's not going to impact on, or most people will understand it's not going to impact on them. I've actually got a few slides, so I might bring those up and just talk to the issue just a little bit more. Just let me share my screen one moment. Okay, so the one thing I did want to say just before we start, and it's picking up a little bit on what Max said, which is when we're talking about taxing, we can tax in those three places. So income And income actually isn't so much of a problem in New Zealand. Yes, absolutely. We could be more progressive. We could have that tax-free threshold at the lower end. We could raise the top end. But actually, income inequality is not so much of a problem. I had a look this morning at the figures from 2024. Between the top and bottom 20%, it's about 5 times. So the bottom quintile the top quintile has about 5 times as much by way of income as the bottom quintile. But if you look at that in household wealth, that is 185 times. So you've got this enormous wealth inequality that we're not trying to tax, and we've got moderate income inequality that we actually do tax, at least to some extent. So the issue really is the fact that there is nothing. There's no capital, no comprehensive capital, wealth, gifts, inheritances, estates, you name it, that we're not really trying to tax any of these things. And I would argue that there's really no good reason for this. Now, I'm not going to talk you through the points on the slide. It's just really to recognise that there are issues. Of course, there are issues with the capital gains tax. There are issues with any types of tax, but it doesn't necessarily mean that any of those are good reasons not to implement a capital gains tax. These taxes are I think actually really quite nice because they're very flexible. You can include or exclude things based on what your policy objectives are. So as normally happens, you can exclude your family home, you can exclude all those sort of personal items like jewellery or artworks, and you can also do things like exclude Māori land, and there's very good reasons why we might want to do that. Obviously, the more you carve out, the less you collect, but and the more distortion of behaviour you get, so that's one of my concerns with the Labour Party proposal. But overall, there actually are no robust reasons not to have a capital gains tax. I was asked specifically to have a look at what some other smaller countries do, and these are just, there's no particular reason for choosing Denmark, Ireland, and Australia as our comparator, but just to provide an illustration of how flexible these taxes can be. What you have in Denmark is you have a rate of 27% on your first 20,000 of share gains and dividends, so specifically on shares, 42% above that. And then what happens is on your other capital assets, they're taxed at your marginal income tax rates, and that's up to 42%. So there's something to be said for taxing capital gains as income. It's very sort of non-distortionary, but other countries have them at specific rates, as you'll see when I talk about Ireland. One of the interesting things with Denmark is they do tax some capital gains on an accrual basis. So normally capital gains are taxed on what we call a realisation basis. So that means when the asset is sold, the capital gain is realised at that point and the tax is paid. But in Denmark, some of the assets are taxed on these unrealised gains. And there's actually good reasons why you might want to do that as well. The blue amount there, that's the amount that they collect converted to New Zealand dollars per annum. So Denmark is actually, it's not too bad, 3 to 4% of tax revenue, about 15 billion New Zealand dollars equivalent per annum. Also, Ireland was another one that I looked at. Now, they have an annual allowance, so 2,500 New Zealand dollars you can have each year before you start getting into having to pay a capital gains tax. Again, it's flexible, but there's a really good reason to do this, which is that you're not collecting small amounts of tax and not having to be overly heavy with compliance. They have a flat rate of 33% on capital gains. Now, in Ireland, and we were talking about countries with higher tax rates, the top income tax rate in Ireland is notionally 40%, but then you add on 8% for a universal social charge and 4% for a social insurance. So we actually end up with a top rate of 52%. So at that point, your capital gains tax rate of 33% is pretty concessionary. Australia, they collect 4 billion, so fairly low amount, but roughly 4 billion New Zealand dollars per annum. Now, Australia, they also treat their capital gains as income at the moment. So they're taxed at whatever your marginal income tax rate is. So that might be 0 through to 45%. Now, this is all changing on the 1st of July, but at the moment you get a 50% discount if you hold your capital assets for more than 12 months. But next year, what will happen is you'll have a minimum rate of 30% that will apply to your capital gains. And that is inflation adjusted, which is quite nice. It means that you're only paying tax on your real gains. Obviously, companies, trusts, etc., would have to also be subject to the tax, and it accumulates over time. So as people's assets increase in value, this is a tax which does increase quite significantly as we go through time. So the other couple of taxes I did just want to touch on briefly here are the wealth taxes. Of course, this is proposed by the Green Party at the moment. So you can see the general downward trend there, but actually what this probably doesn't show terribly well is just how strong that downward trend has been. So in 1990, there were 24 OECD member countries. So 50% of OECD countries in 1990 had a wealth tax. Now we're down to 4. There's 38 member countries, so it's around 10%. So we don't see a lot of wealth taxes anymore. And there are lots of reasons for this. They're hard to collect. Countries want to minimise the potential for mobile capital to be leaving their shores. Wealthy taxpayers have access to tax havens. They generate lots of avoidance and evasion. They're really high in compliance costs and low on revenue. So there's not a lot to argue for, apart from the fact that they are targeting wealth. And that's obviously something which is good to do. And then if we look at the inheritance and gift taxes and the various combinations there, this graph that you're seeing here in front of you is both combined. So inheritance, some countries have inheritance, some have gifts, some have both. So they're combined together there. So if you have an inheritance tax, you really also have to have a gift tax alongside that. So these are the wealth transfer taxes that are in the TGA policy. The trend has been away from estate taxes and more towards these inheritance and gift tax combinations. And the difference there is just who pays the tax. But the thing with these is if you have a look, they're all as percentage of GDP. They don't collect a lot of revenue. So the OECD average there in green on the right, just over 1%. Amongst the other countries, France is just over 0.7% of GDP. So the revenues are low and often really they're just there to exist or minimise the opportunity for manipulation of other tax categories. So even at their highest, they weren't collecting an awful lot of revenue. So, but not having these taxes, again, makes the tax system less progressive. And it means that, and I've got a little tax joke for you here, it means that the wealthy still have that significant tax concession because the gains that they have pass through generations untaxed. And probably don't need to tell anybody here that that's not very fair. It's also not very cohesive from a tax system perspective, and it's obviously not great for inequality as well. I'm going to leave that there.
That's great. Thanks, Lisa. And I think it really highlights the opportunities we have in our system to fill some of those gaps. It seems like a very good time now to talk about corporate tax a little bit more. Before we do, just a wee reminder, everyone, we're going to do audience Q&A after this bit. So please pop in your questions into the chat and we'll look through some of those afterwards. But I'm really excited to be announcing our third and final speaker for today, Nick Miller. He's an international tax expert who has worked as a technical specialist for inland revenue, and prior to that spent over 20 years with HM Revenue and Customs. He has a particular interest in transfer pricing and corporate tax avoidance, and is the author of the Big Tech Little Tax report, released by Tax Justice Aotearoa Better Taxes last year. He's also a member of Tax Justice Aotearoa's Policy Advisory Committee, and today he's going to be focusing on corporate tax. So to kick us off, Nick, how does New Zealand's headline corporate tax rate compare with other countries?
Kia ora, Alicia. It's very good to be here, and thanks for everyone for being with us. Well, the short answer is we're probably around about in the middle of the pack as corporate tax rates stand now. If you take the OECD average rate at the moment, it's around 24.5%, 25%. We're at 28%, so we're slightly above it, but I mean we're certainly not. You couldn't regard us as an outlier. So I think the talk that that our corporate tax rate is too high is probably misplaced, because we're not unusual at all. There's a large concentration. I'll come on to that in some of the slides I've got. There's a large concentration of countries in that 20 to 30% tax rate at the moment. If we could go on to the slides. Thanks, Lisa. Probably need that's. If I could we go back to the what I wanted to do is start with the what's been happening to global tax rates over the past 30 or 40 years, because that's quite interesting as well. And what you can see from this slide is that they've been gradually edging downwards over the last few decades, quite steadily, in fact. And I'm old enough to remember when the corporate tax rate in the UK, for example, was 52%. That would have been in the 1980s, I think, or the 1970s, before Mrs. Thatcher took it down. But interestingly, now that trend seems to have flattened out, and that's partly because of the advent of the global minimum tax, and possibly because the reason why there has been this downward trend is because of the advent over that time period of new taxes, as they were then, like GST, VAT, which reduced the need to collect quite as much corporate tax. So, I mean, that's the global trend. If we can move on to the next slide, please. This is an illustration of what I was saying earlier, that if you look at the position, for example, in 2000, there's a lot of countries in that 30-40% band, and that has now reduced quite a lot, so that we see many more countries concentrated in that 20-30% band, and it's almost a mirror image of what happened in of 2000. There's been this reversal from the 30-40% band to 20-30%, and New Zealand is in that very popular band there. If we could go on to the next slide. This is what's been happening to the New Zealand rate relatively over the same time period. It's also been downwards, but changes tend to be few and far between. The rate stays pretty stable for many years, long intervals between changes. But where we are now, we've been for some time, 28%, and as I say, that is solidly within that sort of popular band of 20-30%, OECD average of around 25%. So there's nothing to suggest there that our corporate tax rate is particularly unusual. Is I think what I'm trying to say. For example, Australia's is 30%, and many other countries are in that sort of mid-20s range. The United Kingdom, for example, it's only Ireland which is really the real outlier in the OECD. Was 12.5%. Will now have to go to the global minimum rate. But Ireland, of course, and I think this was mentioned in one of the earlier presentations, has many more taxes in New Zealand. Taxes capital, taxes has capital gains tax, has capital acquisitions tax, and has a 52% top tax rate. So it does get its revenue from other sources. The structure of its tax system is completely different from that of New Zealand. So if we could just move on to the next one, please. That was of course, that's the headline rate. That's 28% is the headline rate, but it's not always the effective tax rate. What do we mean by that? The rate might be affected by tax rules on companies, and this is not an easy slide to read, but what it actually shows is the effective tax rate in New Zealand is only very slightly lower than the headline rate of 28%. And in many other countries, you can see with the sort of grey, the little grey bit of the bar here, it's actually quite a lot bigger than that, because they have more generous depreciation rates, capital allowances rates. So that's a little bit of a difference between our corporate tax system and many other countries, not only in the OECD, but particularly in the OECD. We don't have particularly generous capital allowances, investment rates, accelerated depreciation. So moving on to the next one. How important is corporate tax to us as well? That's another thing another question that people often consider. And we can see there that we're actually round about the OECD average of around 12%. We're solidly in the middle there. And that's a share of total revenue, not just the revenue collected by IRD, Inland Revenue. It's all revenue collected by government, because if you look at the IRD report, it will say, I think corporate tax is about 17-18%, but that's of the revenue that IRD collects itself. But we are below the global share, and that is probably because many developing countries have a greater share of their tax revenue coming from corporate tax. Many reasons for that. I mean, possibly because they find it easier to collect some tax from multinationals, maybe not as much as they should be collecting, but some, rather than taxing individuals. Tax evasion or non-tax payment by individuals is often at a very high level in some of those countries. So that could be the reason why they rely more heavily on corporate tax. But interesting to see, just reinforcing the picture from earlier, that we're in the middle of the pack again. There's absolutely nothing unusual about our reliance on corporate tax, in the same way that our rate is pretty well in the middle of the pack. So just going on to the final slide here. We're middle of the road, as I was saying, and we like simplicity. So what our corporate tax system doesn't have is many of the things that we might see in other countries. Well, the first thing is we don't tax capital gains of companies generally in the same way that we don't capital gains across the board, which other countries do. So in effect, that narrows the corporate tax base to some degree. We don't have tiered rates. We don't have any progression in our corporate tax rate. So some countries have lower rates or tiered rates for small companies, which may help the cash flow. Small companies may help small companies to keep afloat and keep money for investment. We don't have some measures to encourage intellectual property to be retained in New Zealand, and that's particularly important because we don't have capital gains tax either. So what we do see sometimes is intellectual property developed by companies simply being sold outside New Zealand, and we get no tax from that. What's a patent box? It's a lower rate on profits derived from locally developed intellectual property, as long as that intellectual property is kept in the country. This sort of gets mixed reviews from tax professionals about how effective it is, but it's something that's a number of countries have. Some countries have had it and discontinued it. Quite a number of countries still retain it, so it is an area of interest, I think. Another thing that we don't have is a fixed interest limitation rule. This is something that we refer to in our tax policy document as well. This limits the amount of interest that can be deducted by companies, because I think it's probably well known that interest deductions can reduce the tax bill significantly for companies, particularly if they borrowed heavily from companies in the same multinational group, for example. So this measure, which comes out of the OECD BEPS project as long ago as 2015, restricts the amount of interest to a fixed ratio of earnings before interest, tax and depreciation. So effectively a fixed proportion of the cash the company's making. And that's been quite widely adopted now. I think last time I looked, there were probably about 25 countries that had this rule. That's including Australia and the United Kingdom and a lot of European Union countries. So if we don't have that, then we would start to look like an outlier. What we don't have is a classical system of taxation. That is, we fully impute dividends. That means we give full credit for the corporate tax paid on dividends which are taken out of companies, so reducing the tax bill for the shareholder. And the argument in favour of having that full imputation system is we don't want to tax income twice. I mean, that's questionable because we clearly do in other circumstances tax income twice, GST, excise duties, etc. And some other countries have a partial imputation system, so they tax dividends at a lower rate, but they don't give full credit. And the United Kingdom is one example of that. And it could be argued that full imputation is a disincentive to keep money in companies as well. And finally, another thing we mention and has been topical, has been in the news, another thing we mention in the tax policy statement is tax on shareholder loans, where shareholders, it's been in the news that shareholders will borrow particularly from closely controlled companies, and sometimes those loans are not repaid, and that money is lost effectively. It's never taxed. It's potentially unfair because taking money out as a loan and effectively using it as income gives that shareholder an advantage over particularly, for example, wage earners. So this was a tax on shareholder loans, a limited tax on shareholder loans was mooted by Inland Revenue, but didn't see the light of day in the end. But a number of countries do tax shareholder loans, and we're particularly keen on the UK system where the company pays the tax on the shareholder loan once that loan is made, and we'll only get that tax back once the loan is repaid. So
you might have to wrap up there, Nick. Is there any final thoughts, though?
Well, I'd leave you with the thought that we have a simple system. We're in the middle of the pack, and there's nothing particularly unusual about our corporate tax rate.
Wonderful. Thank you so much, Nick. I feel like I learned an awful lot about corporate tax that I did not know before. So thank you. That was very comprehensive. So a reminder, everyone, please pop your questions in the chat. We have a few coming through already. So I'll just start to go through them for our speakers. The first one was for, I believe, Lisa, during your presentation. How does Denmark calculate the capital gains per year?
Sorry, as in, not sure I understand the question.
Maybe if you just want to talk a bit more in detail about Denmark's capital gains approach.
Oh, yeah. Okay. Yeah. So one of the things that they do that I quite like is this mix of, well, I quite like it. It moves away from simplicity, but they treat some different asset categories differently. And there's a lot to be said for doing this. So, for example, if you've got share gains, for example, they can be taxed quite easily on a method called sort of mark to market. It's essentially because you have a market value of those shares. So you can tax on the gains of those without having to get everything revalued as you would for a property, for example. So I also quite like the fact that they have different rates for different types of activities. Now, again, it introduces complexity, but what it does is it allows you, if you don't completely want to discourage investment in, I don't know, buying shares, for example, then you can have that at a lower rate, or you can have it so that people can engage in a modest amount of share trading before they actually start having to pay a capital gains tax. Some of the other things one of the other things in particular that Denmark does that I like is they treat some types of savings vehicles differently. And again, there's good reason for doing that. For example, if they're targeted towards retirement savings, there's a good reason for having some concessions on capital gains within those retirement savings themselves. So, yeah, perhaps if I just say that. And they also exclude all the usual sorts of things like art and jewellery and personal items.
That's great, thank you. And a great expert on things when you can just put you on the spot about a specific country's capital gains. I love that. Nick, we've got a couple here for you. The patent box regime, does that only apply to the patent holder or to any business using NZIP?
I think the patent box regime in other countries generally relates to the developer of the IP. So it's an incentive to engage in research and development and to retain it in the country. So it's probably better thought of as an extension of an R&D incentive, the type of thing we already have in New Zealand as part of our tax incentives, but the patent box is effectively an extension of that.
Thank you. And the second question, are you able to comment a bit on the prevalence of excess profits or windfall profits taxes internationally and what they apply to?
Yeah, perhaps I should have covered this actually. There a number of countries do have, for example, banking levies of the type that the limited one that was introduced in recently. For example, the UK and Australia have banking levies. The UK has a banking surcharge, a permanent one, of an extra 3% on the corporate tax rate. And the logic of that is that because of the importance, the structural importance of the banking system to the economy, and the fact that you had to bail out the banks in the global financial crisis. There's also windfall taxes. A number of European countries have imposed windfall taxes, particularly on fuel companies. One recent example actually is Portugal introducing one this year on fuel companies as a result of profiteering, as a result of the Iranian situation, and a number of other countries I think are considering it as well. So yeah, they're pretty prevalent, particularly in Europe.
That's great. Thank you. Another expert on this stuff. Very useful. Max, we're going all around the panelists. So a question for you around GST and its regressive nature. Why do you think there's so little attention on the big increase in user pay levies that this government is introducing? The commenters said, are they not essentially regressive taxes? It seems that the government is claiming it's cutting taxes, but aren't user pays levies actually just another tax? This might be more a philosophical question, but go for it.
Look, I think it's a great question. I'll leave the finer points of when is something a tax and when is something a levy to the actual tax experts in the room. Although I note there's always a political sort of posturing about which category something falls into. But essentially, yes, I certainly think that those increases in things like car registration fees and other user pay levies certainly have an effect that's equivalent to a tax on the people who have to pay them. And those things are regressive because they're flat rate, and so they take a bigger chunk out of smaller incomes. And that's one of the reasons to oppose them, apart from the fact that all the other reasons one might oppose user pays, like it turns something that's fundamentally a human right, something an entitlement of citizenship, into something that you have to pay for. Certainly that regressive nature is part of it. And one person who's been making this argument very well is Bernard Hickey, and he has pointed out consistently that the government claims to be reducing inflation by cutting government spending, but quite apart from the various weaknesses in that argument, it's actually driving up inflation significantly, what's called administered inflation, by raising the prices of all these user charges. And although I can't remember the figure, part of our currently slightly excessive inflation is absolutely due to those increased levies that the government is administering. So yes, I think they're hugely problematic in a whole bunch of ways.
Yeah, great. Thank you. The next question is on foreign investors. So open question if someone does have expertise in this. Are there still mechanisms in place to lower the effective tax rates on dividends paid to foreign investors? Do any of our panel have a response to that one?
Well, that might be one for Nick. I know there was discussion about changing the foreign investment fund rules because they are a little bit, well, they can be a little bit unfair for people who have large investments overseas because they're essentially taxed on the unrealized gains of those if they have a portfolio above, I think it was about $50,000. And I did see something about the rules potentially changing, but I don't know where that has gone. And Nick, I'm not sure if you can add any more light on that one.
You're on mute, Nick.
I don't think I can shed any more light on that. There certainly was a proposal to reform the regime exactly for that reason, that foreign investors were effectively being taxed on unrealized gains. And I don't know whether that has actually been turned into legislation. I mean, I think one of the things about the fifth regime in general is that, and I think we made this point when we submitted on this, is that it's so arcane and complex that actually, if you had a proper comprehensive capital gains tax, you wouldn't even need it.
Thank you. Max, did you want to add anything on that one? Cool. Next question is, further to the idea of taxing loans and then repaying the tax when the loan is repaid, wouldn't this also affect the excessive rich people who magnify their wealth by living off low interest loans?
That might be me again. I think the UK measure that I was talking about around shareholder loans, would affect shareholders in both small and large companies But I think what that question might be referring to is the sort of what's known as the buy, borrow, die sort of system where you actually you live off the borrowing from you borrow against your investments, and you because we don't have capital gains tax, you never pay any tax because borrowing is not income. So you're able to effectively reduce your real tax rate to virtually nothing. This is why you can get these figures of 9% for the richest people in New Zealand, for example. I think you would need to deal with that through a separate measure than the shareholder loan system.
Awesome. Thanks, Nick. I'd love to wrap us up with one key takeaway I think that everyone has. What is your key takeaway from other countries that we should think about as a country, particularly as we head into this election season and we think about what our tax system should look like in future? Let's work our way backwards. So Nick, we'll start with you.
I don't think we need to lower our corporate tax rate. I think we need to think about incentives to make sure that we encourage productive investment.
Perfect. Lisa?
Well, this would come as no surprise. We need a capital gains tax, but we need to be very clever about how we communicate this to our taxpayers.
Yes.
On similar lines, I would say the thing that always stands out to me from our tax system is we ask very little from the wealthiest New Zealanders in terms of the amount of tax they pay. As Nick and I have referred to, the wealthiest New Zealanders are paying a 9% tax rate, which is crazy in a world where we would probably think they should be paying 39%, certainly on the upper echelons of their income. And I think just holding that fact in your head, the wealthiest New Zealanders are paying 9% of their income in tax, is pretty crucial.
Awesome. Thank you. Thank you so much to all three of you today. I think it's given some really great understanding of how we look internationally, and also I think really highlighted why Tax Justice Aotearoa's work is so important, and particularly in some of that how we communicate and how we talk about tax in a way that is going to be more progressive for our country. So thank you everyone for coming along today. Thank you for the questions in the chat. They were really great. You can get involved in the campaign. I see that you've already got some links in the chat. So if you're keen to get involved, there are 3 things that you can do right now. You can sign up via the link in the chat, fill out a volunteer form, link also in the chat, and if you want, make a donation to the campaign as well. We'll email you through all the links to these and the webinar recording as well, if you want them. So thank you all. Enjoy the rest of your day, and thank you so much to our speakers for sharing your expertise with us. Ka kite.